Welcome, everyone. My name is Kelly Richardson, and I am the 2021 board president for the Washington State chapter. Really happy to have everyone online here today. We're going to have a great program, and it's all about tax and tax update and what's on the horizon. So it should be very interesting. We're very fortunate today to be co-hosting this program with FIABCI. And I'd like to introduce the 2021 president of FIABCI, Kelly Horn. Kelly?
Thank you, Kelly. And thank you, CCIM, for consistently hosting one of the most informative and anticipated events of the year. It's always an honor for FIABCI to have such an esteemed collaboration with this organization, and we look forward to many more successful partnerships in the future. So what is FIABCI? Although many of the attendees here this afternoon already know all about FIABCI, allow me to introduce our organization to those individuals who do not. For over 70 years now, FIABCI has been an established international real estate organization that carries a unique twist. Unlike many other real estate organizations, we focus on so much more than that. FIABCI provides the means to business network with all professionals associated within the real estate industry, commercial and residential. This is an extremely beneficial resource when reaching out to all of those associated with a potential deal or an existing project, no matter where in the world they're located. And since FIABCI currently has over 48 national and multinational chapters around the globe, it's much easier to connect to specific individuals when you reach 5 continents and over 70 countries. Some of these FIABCI professionals associated within real estate include developers, architects, real estate attorneys, environmental engineers, surveyors, brokers, bankers, agents. The list is limitless. If you're ambitious and looking to expand your business or clientele, FIABCI permits such access to that national and international network, opening up a magnitude of new potential opportunities. In closing, I encourage all of you to learn more about FIABCI membership, benefits, and upcoming events. Thank you all for your time and allowing me to go on and on about this remarkable organization. Back to you, Kelly.
Thank you, Kelly. And attendees will also get an email with more information about FIABCI. And this webinar will be recorded too, so we'll have that later on our YouTube channel and also on our website at CCIM-WA.com. I'd like to thank our annual sponsors, the Benaroya Company, Lisa Goodman and Larry Benaroya, industrial office developments. We really appreciate the sponsorship for them and all of our power partners. Also, IBA, Kurt Meyer, mergers and acquisitions. So check them out. There's a lot going on with that. Stuart Title for all things title. Thank you very much to Kelsey Azure. And then Rob Sargent, a longtime real estate attorney. He's formed his own company, Sargent Legal. Thank you so much for being part of our sponsor. And then Kevin O'Keefe, Ameriprise Financial. He does asset management, as well as making sure that your portfolio is right for your goals. So check them out. Our annual sponsors, Fred McConkey with McConkey Development. Also Great Earth Realty. Thank you, Larry. Myself, Raleigh Properties, Kelly Richardson. Dirtfish, check them out. They are a rally car racing school in Snoqualmie. And Blue Ink Real Estate, commercial and residential up in Bellingham. So check them out as well. Thank you to our in-kind sponsors, BDP Design, Kelly Beckley, All Things Marketing, and then Daily Journal of Commerce. We really appreciate all of the opportunities that you folks bring to us. And thank you all for the sponsorship and making CCIM what it is and helping us as we move forward through this wild and interesting time that we have here. So with that, I would like to take a look at our 2021 Board of Directors here. And as you can see, this is our 2021 slate of officers and directors. So thank you very much for the great team that I work with. We have got a lot of good things going on. And so I'll talk a little bit about that as we get into some other things here. Today, we are honoring our past presidents. I want to thank all of our past presidents very much for volunteering, for your contributions, and for your commitment to CCIM. You folks are what have made us great. And we are the elite professionals out there in this commercial real estate world. And it's an honor to be part of this group. So thank you so much. And we'll move on to, we have something new that we've introduced for CCIM Washington State. And this is our real estate consultation clinic. This is every Thursday from 4:30 to 5:30 p.m. And it's a great opportunity to chat with experts in the field and also network. So today we have Larry Yu, and he's going to be talking about retail, all things about retail, what's happening right now in the Puget Sound, what you can expect to see out there, what the possibilities might be of the future. And so there's a link on our website at CCIM-WA.com. And you can see here, we have various different asset classes each week, and this is free for our members as well as non-members to come check us out. We'd love to have you. So next month's program is the future of brokerage. And this is the webinar February 10th, and that'll be from noon to 1 o'clock. We're really excited to have such great panelists. Chris Bornhoff with the Windermere Manitou Commercial, of course, Bob Wallace with Wallace Properties, John Miller, CBRE, and Scott Coombs, NAI Puget Sound Properties. And they're going to be talking about, with all the changes going on, what do they see in the future? And so that's going to be something very interesting, how virtual world is impacting us, what sort of tools you might see engaged in now and as we move forward. So check again for our website, CCIMWA.com, to register for that. And the Institute is offering the CI 101 and 104 classes in an online condensed format. Please also visit our website for more information on these classes, CCIMWA.com. Now we're going to get into some housekeeping items, and you can see here if you have some troubles with Zoom, you can see what to do. We are recording this webinar. It will be available on demand on our website later this week, so please check that out. And then you can also upvote questions. We'd love to have that. With that, I'm going to be introducing our moderator today. We're honored to have a past president with us, Fred McConkey. Fred, I'll let you take it away.
Thank you very much, Kelly, and thank you for everybody joining us. You should have a very interesting program today. It's about taxes and the new administration coming in. And I'd like to introduce our panel, and then they can kind of give us a little update on what they do and a bit about their firm. So Benton Bray, would you like to introduce yourself, please? So unmute there.
Sure. Yep. Let me get turned on. Happy New Year to all of you. And certainly cheers to a much better 2021. It's certainly been interesting this last year. I've been around the tax game for just a few years. Have seen tax evolution over the last 30, 40 years. And I think we have some more coming our way. I mean, for all the CPAs on this discussion today, I think we can all attest we love relearning our jobs every year as they change the rules. So glad to be part of this.
Thank you. Lyell, would you like to introduce yourself, please?
Yes, I am Lyell Fracas, and I am a director at Clifton Larson Allen in Bellevue. I specialize in real estate, mostly in tax, but I do some insurance work as well. Good to see everybody today.
Thank you. Tyler Opp.
Thank you, Fred. So my name is Tyler Opp. I'm one of the CPAs and a partner here at Benton Bray, business partners with Brian down the hall. Majority of my practice is surrounding with real estate construction and development, mostly closely held family entities, large family groups, and things of that nature on the tax and consulting side. So appreciate the opportunity.
Thank you, Tyler. And Ken Williams, like to introduce yourself, please?
Thank you, Fred. Welcome all. It's nice to meet you virtually. Ken Williams. I'm a principal in the Seattle office of CLA. I head up our tax practice here and do a lot of real estate, flow-through entities, and transaction structuring. We have about 180 people in the Seattle office and about 7,000 people nationwide. So love to work in the real estate place, and thrilled to be able to be part of this today.
Great, thank you very much, Ken. So we'll get started. I have some questions, and this first one is for Brian Bray. And so to what degree do you think the pandemic relief programs influence tax policy? In other words, will the magnitude of the pandemic spending programs mandate higher taxes?
Well, one can't imagine otherwise. Just to kind of put it in perspective, as we've kind of been asked this question, many times by our clients, is I went back and did a little research on what the cost of World War II was, for example. And in today's dollars, World War II cost $4.1 trillion. And interestingly, with the COVID legislation that's already been passed, and Biden's team has announced that they're going to get right back to Congress and pass more. As you all may be aware of the HEROES Act that the House introduced back in May and that never made it through the Senate. They were asking for $3.4 trillion of COVID relief. And what got passed here at the end of the year was about a trillion two short of that. So to date, they've already passed in excess of $5 trillion worth of COVID relief legislation, more than the entire cost of World War II. And they're not done. And then you look at what the federal deficit has done. In the last year, the federal deficit, or not the deficit, the federal debt has increased $4.5 trillion just in 1 year. So it's gone from about 23 trillion to 27 trillion. A lot of money going out. It's got to be paid by somewhere. So then I correlated that to the history of income tax rates, and coming out of World War II, the top marginal tax rate was a whopping 94%. Hard to believe, but 94%. When I first got in the CPA business many years ago, the top marginal rate was 70%. And then when Reagan came in, he got the top marginal rate pushed down. We were all going hooray when it hit 50%. And it actually got as low as 28%, and now has gravitated back to 37%. So in short, I think we can expect higher tax rates on certainly the higher income crowd. Biden has made that clear that, the line he has drawn is at about 400,000 of taxable income. If you make more than 400 grand, you can expect you're gonna pay more taxes. Same on capital gains rates. We've seen those rates kind of trail the ordinary income rates. The mechanism used to be half the ordinary income rate was your capital gains rate, and hit a low of 15%. Now we have this dual layer cap gains rate at 15 and 20%.
Great, thank you very much, Brian. One other thing while we're on the topic, but they're trying to pass a second stimulus program, and I guess it has passed. Can you tell us just an overview of what that entails and what it takes to be eligible for it?
Sure. So the bill that passed there right at the end of the year, and I believe Trump signed it into law on the 31st, provided for a second round of the PPP loan program. This round is going to be means tested. So the means testing is if you've had a reduction in revenue of 25% or more in a single quarter or annually, 2020 over 2019, you'll qualify for another round of PPP loan, forgivable loan. It's going to be calculated the same way, 2.5 months of payroll. You're going to be able to use your 2019 payroll or your 2020 payroll if it's higher. This is going to be a beneficial impact for many of those businesses that had to physically shut in middle of March to about middle of May. Medical, dental, retail, restaurants for sure. So there's a lot of industries that have been hardest hit that will benefit from this program.
Great. Thank you, Brian. Appreciate that. Well, we'll move on, and Ken and Lyle, you can both kind of work on this section, but just in terms of taxes in general, can you tell us what you think might be coming for depreciation, 1031 exchanges, business losses, capital gains? I think those are all on the chopping block. And can you give us a little summary of where you think it might be headed?
As far as depreciation goes, there hasn't been a specific plan announced. We're currently just dealing with the changes that have occurred that have actually been put into law recently. And probably the big one is changing the ADS for those taxpayers who elected 163J, changing the life from 40 years to 30 years.
Thank you. How about 1031 exchanges? What do you think might happen there?
Yeah, so President-elect Biden has signaled that he's got 1031 exchanges in his sights. He's not been very precise about what that will look like. And of course, as things get sorted out and lots of sausage gets made, particularly with a divided House, we honestly don't know what's going to come out of that, but it is in his sights. He views it as an area of abuse. But let's not forget the intent of 1031 was an economic incentive. It was intended to allow for the free flow of capital, to allow people to be able to transfer their invested capital without the tolling of a tax hit, just to move from one piece of property to another. That was the whole point. And that's a good economic incentive. That there's a lot of weight behind that now. The 1031 exchange has been around as long as I've been around in public accounting. And so I don't see it going away, but I do see a significant incentive to trim the edges of it. I could easily see legislation that might go after pre or post borrowing on 1031 exchanges, to be able to say, well, gee, if you're exchanging properties but you're still borrowing money and getting the cash out of the deal, that's the same as if you sold it and got cash. So we don't know but what's going to happen there. But we got a lot of inquiries the end of last year saying, well, I better just do this exchange while I still can. They already did eliminate it for non-real estate property. Last year, as part of the 17 Act, they eliminated the ability to do 1031 exchange for anything other than real property. So there already is some snipping at the edges of 1031. I think we can expect that. But what form is going to be anyone's guess, depending on who's got the strongest lobby on Capitol Hill. So we'll have to watch that very carefully. And as we're working with our clients, we're trying to walk through and say, okay, do we take the safe approach now? We have some clients that are going ahead and realizing taxable sales to get low capital gains rates and kind of reset in the fear that tax capital gains rates are going to go back up, as Brian pointed out, is a possibility. And then they can move forward with stepped up basis and so that they don't necessarily have to rely on the 1031 vehicle.
Kind of along that same line, what do you think about business tax rates and personal tax rates? What might we be looking at there?
Yeah, so Brian alluded to this. We've seen them all over the board, and President-elect Biden's current proposal is to increase the individual rate for taxpayers over 400,000 of adjusted gross income up to 39%, for corporate rates to increase from 21% up to 28%. And that's kind of what grabs the headlines. But those of us who have been around the block a few years and lost a little bit of hair in this know that often the biggest hits are the silent ones that don't draw all the headlines. And eliminating the 199A deduction is a big one. That 20% deduction that is currently being able to be applied to real estate income as well as other sources of income from flow-through entities. And Congress has become very adept at this idea of, I love the quote from Jean-Baptiste Colbert. He said, the art of taxation exists, it consists of so plucking the goose as to procure the largest quantity of feathers with the least possible amount of hissing. And I think that we see that a lot in tax legislation. It's how do we get at this without increasing the rates even more by eliminating deductions, by phasing out deductions. I think we'll see more of that. There's a whole playbook that Congress develops in that area to try and increase revenue without being accused of increasing rates.
Great. Thank you very much. I appreciate that, Ken. Tyler, just a question for you. First of all, what is this 199A and what might be in store in President-elect Biden's tax policy?
So the Section 199A is a deduction that was created at the end of 2017 under the TICJA law that was passed there. Essentially what it allows for is a deduction equal to 20% of qualifying business income, that QBI number that you often hear referred to. So essentially it's a 20% deduction on taxable income, and real estate income, both rental income and development income, those types of brokerage income, for example, as well, qualify under the law for that deduction. Biden, as Ken has alluded to, has mentioned in his proposal that he released last summer that he would like that to be on the chopping block for individual earners who have incomes in excess of $400,000. So what you've got is a deduction potentially going away coupled with tax rate increases. So what you've really got is a double whammy in a lot of respects.
Thank you. One other thing, if these things do get passed, do you think it'll be retroactive to January? And, are there anything, other things that, they might be looking at to raise the revenue? It seems like they're trying to make everything off of people over 400,000. If you're under 400,000, is there going to be some tax changes also?
Well, in the proposal as it currently stands, everybody under $400,000 is allegedly going to be somewhat unscathed from this. But I would urge some caution as well, and remind listeners that tax law changes are really, really complicated to get through. Even when you control both houses of Congress and the presidency, it's difficult to do even when you're decreasing rates in a generally popular fashion. So you add and you couple the fact that we're still in the midst of a pandemic, the largely popular business-friendly deductions such as QBID, and you've got a very, very divided congressional system as well. It's really complicated to get this stuff passed, even when the stars align and you add all the other stuff that we're currently going through. I think it's going to be tough. And keep in mind as well that the proposal in its current form is just a wish list at this point. Given how divided government is, a final product would almost certainly look very, very different, if not very, very scaled back. But to answer your question, Fred, there is precedence for things to be retroactively dated. It's happened before. There's case law that would support its ability to do so, but it just seems unlikely. Again, even if Congress started working on this on the 20th, the day after the inauguration, it's going to take a significant amount of time for Congress to get their act together. And I think they've got some other priorities as well, whether that be vaccine rollout or other things they're going to take some political capital to get done. And so I don't think that even if it does get worked on relatively quickly, that it would be passed anytime within the first 100 days or even into this summer. And for the ability to then backdate that after taxpayers have already made business decisions and how they're working with their businesses on a go-forward basis, that's a tough pill to swallow, especially when it's retroactively done. I think it's much more likely that that would be on a proactive basis, such as Jan 1, 2022.
Thank you very much. I appreciate that. So Ken, we talked about opportunity zones here, and some people in CCIM are getting involved in that. Do you think that will survive this tax reform?
I'll take that one.
Okay, sure. Thank you, Lyell.
Opportunity zones were designed to allow investors to put some of their capital gains funds that they received from the sale of property into underserved communities. There were a certain number of communities that were designated as these opportunity zones. And the taxpayers were given certain beneficial tax rates and deferral of taxes by when they, invested in these areas. But this program is perceived to be abusive by some, and Biden is one of the ones who wants to make some changes to it. Most of his changes involved, there were three things really. One is to incentivize the funds to work more with community organizations and nonprofits and make sure they're actually getting jobs and benefits into the communities that they were supposed to be helping. Also, there is a possibility that the Department of Treasury will get involved in reviewing what the funds are actually doing to make sure they're staying, that they're not just giving high returns to investors, but that they're actually helping the people who live in those areas. And then the third thing is maybe requiring more transparency, requiring more disclosures from the funds, and public support, public reporting, and that sort of thing. As far as whether or not the program will survive, most Republicans and Democrats like the program, and they don't necessarily they don't have a reason to want to get rid of it as long as it's working as it should be. One thing that's a little unsure right at this point is because it allows you to defer capital gains, whether or not it makes sense to defer capital gains if the capital gains rates were going to be going away.
Thank you very much. Appreciate that. So we usually structure our entities in LLCs, at least that's most popular now. Do you see people structuring their entities for purchasing and holding real estate in different entities, or adjusting how they do that in the future should tax laws change?
Yeah, so the particularly after the 2017 Act, flow-through entities, and particularly LLCs, partnerships, have always been the vehicle of choice for most real estate activities. With the lowering of the corporate tax rate, there was a little bit of a swing of a pendulum to say, well, gee, that 21% really looks attractive. But usually when you ran the numbers, it still made sense to do a flow-through approach with partnerships, LLCs, in order to avoid the double taxation, once at the corporate level and then once again at the individual level. So that's always been the standard thinking, and we've really not seen a shift as yet of restructuring. But if you look at the potential tax law changes, if the capital gains rate were to go away for certain individuals, where you're paying ordinary tax rates of 39% on capital gains, if you also did away with the 199A deduction that Tyler was discussing earlier, that 20% discount on the effective tax rate for qualifying business income, that starts to tip the scales a little bit, where people may say, well, gee, maybe a corporation structure makes sense. I think it's a stretch at this point, but it's something that we'll have to look at and model as tax reform evolves. I think the other thing is that we see a lot, not as much in real estate, but many deals are put together with carried interest provisions to allow investors to get capital gains treatment on their services that they're providing. And carried interest has been in the sights. It was certainly in the sights of President Trump and is also in the sights of President Biden, President-elect Biden. So we could see that affecting, well, gee, do I really want this structure if I can't get capital gains treatment, or if capital gains rates aren't of any benefit? Do I really want to continue to have a flow-through structure, particularly in entities that are in multiple states and you're dealing with a lot of compliance, or you might just want the simplicity of a corporation. So no big shifts yet. I wouldn't be advising my clients to change their structures yet, but this year we're going to be watching very closely, look at tax law changes to say, is there something different we should be doing as a result of this because of a change in rates between corporations and individuals?
Thank you very much, Ken. Also, people can ask questions on the Q&A. That's the best place, and there's been some things coming in chat, so we'll get to those questions in a little bit. So what I've been hearing, it sounds like tax rates are probably going up for people over 400,000, a lot of people that own real estate and make things happen. And then we're also trying to pull ourselves out of a recession, or at least a very different economy that we've ever had, tons of debt. And just looking at our area here in Bellevue, Washington, you know, are we somewhat protected? Will our economy do okay? Or do you think that these changes are really going to hit the overall economy, maybe even the stock market, and things could tumble back into a recession? And so that's kind of an open question for people to give us your ideas on that.
Well, I'll dive in here and go ahead,
Okay,
Brian.
I'll just piggyback on you, man. Go ahead.
Yeah, you know, there are a lot smarter people out there than myself who don't know the answer to this question, obviously. We talk regularly with our clients. I think there is cautious optimism going forward that there's a certain amount of pent-up demand. I think it really depends industry by industry. And as far as real estate, well, frankly, I've been surprised that we've been as resilient as we've been in this last year. But you know, it's all connected, and so the real estate is reliant on so many other industries for its success. And I think that there's cautious optimism for the long term, but I think a lot of people are basically trying to keep their powder dry and realize that we are far from out of the woods yet.
I think the savings rate is actually up, but Brian, do you have some comments on where you think the economy's going?
Just to piggyback on that, Tyler and I were talking about this earlier, and we live in a region that is blessed with the industries that are anchored here. And I think compared to, you know, the rest of the country and even worldwide, we have a pretty rosy economy here. You know, tech really supports our economy here. And quite frankly, what we've been seeing from our clients now, although we don't have any restaurant clients or hospitality clients, but you know, anything real estate or construction, medical, dental, professional services, our clients as a whole have been doing just fine. And I look at the activity in our own practice, and the activity in our practice is up significantly last year, even during the pandemic. But we've got to put that in check. You know, nationally, the economy is still soft, and certainly worldwide. And then as it relates to real estate, I can tell you from experience, I don't know what you guys are doing at CLA, but here, you know, we've duplicated our employees' ability to work from home, and we got about half of our crew working from home. And they're getting kind of fed up with it. As practice owners, we've seen an impact on productivity from the loss of, you know, elbow to elbow collaboration. And the employees working at home, they're experiencing challenges to productivity because typically they're at home because they have kids who can't go back to school, or they're concerned about COVID and won't come back into the office. So as it relates to commercial real estate, office building real estate, it's not dead, but I think there will be a continuation of some form of work from home, you know, work in the office combo. There will be a need for commercial space. Now, Fred, as you know, we moved into our new office in November of 2019, and we've kind of scratched our heads. Would we have done, you know, set up our shop the same way as we did in 2019 if we were setting up our new office now in 2020? And I think it's a split decision, but there's certainly a hard possibly, yes. We have more space now. We could have gone to, than we use. We could have gone to a form of kind of a bench style shared workspace and supported this work from home part-time, work at work part-time, and probably gotten by just fine with about 2/3 of the space we actually took down.
Yeah, I we'll get back to the economy, but just I'm a landlord, as you know, and I understand that there's a ton of sublease space, and it's mainly downtown Bellevue, where some of these big corporations are dropping floors. And I think that if you're in the tech business, they might think that they can survive with half their people living at home. I think that they'll miss their productivity going forward, but at least for right now, the first quarter of 21, there's a lot of sublease space in office. And then apartments, I think, are kind of having some trouble too, that people are moving out of downtown for various reasons in Seattle. And that vacancy is actually going up where they thought it was resilient before. And retail restaurants, I've had 2 restaurants go upside down. They've had a tough go. But industrial is actually quite strong because everybody's ordering stuff online and the ports are going and things are pretty busy. So do we have any more comments about the economy? Tyler, what do you think about the economy and people doing real estate?
Well, as Brian and I constantly pontificate back and forth and discuss, I think that the Puget Sound region, the long-term thesis of this area is still very, very strong. Obviously, there's going to be some ups and downs here in the potential short term as we kind of figure out our overall response to the pandemic and as we emerge out of that. But the Puget Sound area is still a very desirable place to live and to work and to raise a family. I think for the most part, you know, I'm born in Issaquah, raised here for my entire life. And every time I travel away, I always look forward to coming home because I love the Puget Sound. And I think the Puget Sound is still seeing an influx of people with the vibrant economy that we still have. So I think the long-term prognosis is still very, very positive. But the real question to real estate development, whether that's residential or commercial, is still going to be interest rates driven at some level. And we've seen some relatively elevated asset prices, quite frankly, as a result of cheap money. And what's the long-term impact of that? I don't know. And I think there's some very, very bright people out there that don't know the answer. So I think we'll have to wait and see. But long-term, 5, 10, 15 years out, I think Puget Sound is still here and vibrant and strong.
Lyell, what would you say about our local economy? How do you think things are going to shake out this next year or two?
Well, I kind of agree. The next year or two is still going to be kind of shaky. I mean, I've heard a lot of really mixed from people who've been working at home. Some of them are just really sick of it and ready to go back to the office, and other people have really adapted to it, and I think they want to continue to do it going forward. So I have heard that people have been moving out of like downtown Seattle because some of the benefits of being there, like the walkability, is just not there right now. You know, you can't walk to a restaurant, you know, or can't walk to work because you can't go there. And I know people who've moved out of the downtown just because of that. But once all of this goes away, I still think there's going to be a shift back to, you know, those being desirable as they were before.
Yeah, I'll just, if I could just comment here, I think there's likely, I think there's likely to be a shift. I think that with the initial wave of the pandemic, definitely had a much bigger impact on commercial than it did on residential, right? The commercial just has taken it in the teeth as buildings have sat empty and subleases are out for let. And at the same time, I think that the residential market has been remarkably resilient, but I wouldn't be surprised to see that shift. And over time, as the Amazons and Microsofts are telling people, don't bother to ever come back to the office, you're going to see, I think you're going to see that impact the pressure on residential real estate. At the same time that for all that Brian and Tyler and Lyell have said, you're going to see a lot of companies saying, look, we've tried it. We do for certain businesses, we've got to have face-to-face teamwork going on. I know my son works for Apple, just moved to Austin, and they're anxious to get everybody back because they realize they work better that way. And so I think that the tide may shift, and we may see a longer impact in the Seattle area on residential, a softening there, and maybe a rebound in commercial. But how long that takes, who knows? And like I said, there's a lot of smarter people than I that don't know the answers either. I'm just dumb enough to have an opinion.
Thank you, Ken. Appreciate that. We'll get into some questions, and some questions are coming in, some good ones. But one thing I want to ask, well, Brian, as you know, I did a bunch of estate planning in 2010, thinking that the laws were going to change, and then they kind of didn't change. What do you think is the future for estate planning in the Democratic administration?
That's a good question. So a little history lesson back in 2010, when actually, wasn't it 2012 for you, Fred?
Yeah, I guess we started.
Somewhere in there.
Yeah.
So back in 2010, the estate tax, or the unpopular death tax, came within a whisper of being abolished altogether. So there was support on the Democratic side and the Republican side to make it go away. And I've been told that, part of the reason behind that is the general population. If you were to, stop anyone on the street and say, hey, when you die or when your parents died, do they have to pay death taxes? And incorrectly, too many people think so. Tyler and I were talking about this morning, and that's why I think there's probably, abolishing the death taxes in favor with both sides of the aisle to appease their constituents. But the current estate tax regime sunsets in, 2025, Ken, I think?
Yeah.
And Biden has, his plan on his wish list. He's talked about rolling back the current lifetime exemption, which is roughly $11.5 million per person, back to the $5 million benchmark. And, we've talked internally, we go, well, why would he burn that political capital fighting that battle when the current structure is going to sunset in just a handful of years anyways? So, yeah, who knows, Fred? I mean, there's been talk about the abolishing the estate tax over the years, and it's just a matter of whether or not it's worth the fight in Congress. I think the real fight is probably over income taxes, and the group that doesn't want to see an increase in income taxes, and well, that's all of us, but the people in the middle. And so I think drawing that line at the $400,000 is largely going to appease the masses of the people, and the north of 400 grand is going to hit the single digit part of the population that makes that kind of money, the 1, 2, 3% of taxpayers. So I would vote that the estate tax is not going to change a heck of a lot. In fact, historically, once the lifetime exemption has gone up to a new threshold, it's never retreated. When I first started in this business, it was the lifetime exemption was 600 grand. Then it creeped up to $1 million, then 3.5 million, and 5 million, and then jumped to the 11.5, and it's never gone backwards. So, Ken, what do you think?
Yeah, I agree. If you look at the amount of revenue produced by the estate tax, it's not significant given all the structure that has to go in around it. I think the interesting aspect of this is one of the things that Biden had discussed is doing away with the step up in basis, and that to me is a bigger fish. I have a difficult time imagining that actually getting through, because I think there's such a political momentum around allowing for that step up in basis on death, allowing everything to get a new basis so that gain isn't taxed. But there's a lot of revenue that could be generated by not giving that step up, probably more than is generated by the estate tax because of the $11
Sure.
billion exemption. So,
But what do you think about the practical implementation of that?
well, that's just it. I don't know how you do it. He's talked about it, but I don't know how you would do that on a practical basis. I think it would just upend so much of our current structure and introduces all kinds of other problems. So he may be looking at that, but I don't see it. I don't see it happening. But I think that that's part of the idea of what do we do with the estate tax? Well, gee, if we get rid of it, then we can also get rid of the step up and we can generate more revenue. I just don't see it happening.
Thank you. So anyway, we have a question coming in. It says our state government has introduced a 9% state capital gains tax. Now both houses being Democrats, there's a lot of movement to push that tax through. The Senate Ways and Means Committee is holding hearings on that issue. Please, will you assert whatever pressure you have to oppose this tax? In other words, do you think that this tax is going to happen? I actually didn't even know it was on the being introduced. Can anybody give us some background on that one for the state of Washington?
Well, I guess I could start. Things like this have been introduced into the state before, and you know, Washington being one of the few states that still does not have an income tax. Most other states do. It's been pretty repeatedly shot down, and you know, we're CPAs here, we're not attorneys, so I don't know the constitutionality from the state constitution, whether or not it's ultimately going to hold up statewide or even citywide, because the city of Seattle has attempted to do similar things in the past. But I would just revert to my earlier comments that tax reform changes, especially when we're talking about tax increases, are really complicated to do. And they're relatively unpopular, even when they don't necessarily affect the specific demographic of people. So it's easy to create a narrative. It's easy to create optics of who it's ultimately going to impact. And it's easy to create headlines of unintended consequences. So I wouldn't be shocked, but I would be very, very surprised if the state of Washington ends up with the state income tax, whether it be on capital gains or income or really anything like it.
I think the real issue here is definitional. It's my understanding it would require an amendment to the state constitution for the legislature to pass an income tax in the state. And I believe what they're arguing now over this capital gains is that a capital gains tax is not an income tax, but that's been shot down. And time again, capital gains tax has been defined as falling within the definition as an income tax. I believe that's my understanding. Is that yours, Ken?
Yeah. You know, you never know what the courts could decide, but that's been our past experience as these things have been floated over time. And yeah, I think it's great at getting political headlines and sending the message you want to send, but usually at some point it breaks down without a constitutional amendment.
Great, thank you very much. Reading some more of our Zoom questions, let me see here. Basically, Candace, one of our CCMs, said that yes, people are moving out of Seattle, vacancy rates are going up, rents are going down, and then in the suburbs, it's getting better. And then from my personal experience, when the pandemic hit, I thought that the real estate market in general would just be totally clobbered, but we were able to sell a vacation property in Montana that we couldn't sell the year before, and then this year bought a place in Sun Valley and we were lined up to buy it. So anyway, these destinations or places out in the woods are going kind of crazy, and home remodels are going crazy, and it seems like it's kind of a real bifurcation between the haves and the have-nots. Some people really have it rough. But have you seen your clients doing this, like spending more money on vacation homes and moving out of different places? How about you, Ken? What have you seen with your people?
Yeah, well, it's still a little bit early to tell. You know, we'll probably see more as we're headed into the thaw this year. But we have seen people just kind of trying to say, well, how do I maximize the value of what I've got and make this workable space? A lot of emphasis on, if this is the new normal, this telecommuting and so forth, how does that impact the value of my properties, whether residential or commercial, and what can I do to adapt those properties to allow it to retain value? So a lot of emphasis on that. And of course, a lot of people looking east of the mountains say, boy, I can transfer a lot of value out of here and cash in. That's the obvious fear for everyone, is to say, well, I don't want to be the last one out. And what does that do to residential rates? That's why I say I've been surprised that it's been as resilient. But yeah, one of the commenters here, Candace, I agree. She mentions about second homes, that market's on fire. People are looking to have that place away.
There are definitely people who, you know, live in like a 1-bedroom studio and they're both now working at home, you know, and finding that just doesn't work, and they're having to make moves because of that. You know, if going forward that's going to be the new normal, then some of those smaller places just don't work anymore.
I think one of the proposals Biden made is for a renter's credit. I don't know how that's going to really affect behavior. I think they put a little too much trust in whether that's really going to make a decision. But the idea is to try and incent people to continue to rent, to not put their thumb on the scale of home ownership maybe as much as they've had in the past by offering this renter credit. Whether that goes anywhere or not, I don't know. But it's an interesting twist I saw.
Great. Another comment in the chat and the Zoom is that we really can't predict the economy. We kind of think that we can, but it's very difficult. And it just seems like everything that's hit us hard, we didn't see coming. I didn't see the mortgage crisis. I don't think anybody predicted COVID would come and knock everybody flat. So it's very difficult to predict the future, but I do feel some comfort that our Pacific Northwest region's in better shape than a lot, just because of the tech businesses that are here. One other comment, a person asked what the corporate tax will go to. Brian, I think you were covering that one. Do you know what the taxes will be for corporate tax if the Democrats get what they're trying to do?
Well, the corporate rate got reduced to 21% and effective 1/1/2018 as part of that 2017 tax legislation. The reason for that was to make US-based corporations as competitive, so to say, more of a even playing field with other countries around the world, that our corporate tax structure was a disadvantage for US corps. And so that was the reason for the driving it to 21%. But on Biden's wish list, he's looking to push that back to 28%.
And weren't they trying to get the American companies to bring money back home again too? Wasn't that sort of a penalty too?
That was, you know, another draw to lowering that corporate tax rate, is to encourage US companies to repatriate those profits parked in foreign tax havens or countries, you know, like Ireland, to bring them back to the US and reinvest in the US. I don't have any stats on how much money came back, but I believe it was quite significant. Have you, Tyler, Lyell, Ken, have you seen any stats on how much money was repatriated?
I haven't seen any numbers. We've dealt a lot with the tax consequences of that repatriation, because to bring the money back, they had to pay some tax on it. And so we've seen that, but I've never seen it tabulated as to what the total transfer was. And of course, the bigger issue is, did it stop the flow of more money being expatriated by lowering that rate? Companies that were maybe looking at doing inversions and other things, saying, well, gee, maybe we'll stay here. So it's hard to really quantify. But yeah, where the previous rate was 35% and it dropped down to 21%. And I know during the discussion of all of that, tax law legislation, they were saying, well, other countries are having corporate tax rates that averaging between, depending on who you talk to, 20, 25%. We need to be competitive so that businesses aren't incented to go offshore. And so raising it back to 28%, you start to create that problem again. Do you say, well, maybe we only increase it to 25% because that's the average, and then we're at least as competitive as other countries? I don't know. Usually when there's tax reform, that's part of the sausage. As Biden says 28%, somebody else says 23%, and you settle at 25, who knows where we'll end up.
I mean, if we want to look for an example of how tax rates, U.S. tax rates relative to foreign tax rates come into play in that kind of competitive decision-making process, all we got to do is look to California. Look at all the millionaires and billionaires who are moving out of California because of what California has done with their state tax structure. I mean, Elon Musk folded up his tent and moved to Texas.
Great, thank you. There's one other question. If federal rates increase, what might be the effective date? And I think Tyler covered that earlier, that they could make it retroactive to January 1, but it's fairly unpopular and really probably not going to happen, but it could. One other question. I want to say
the last time I saw tax rates kind of get implemented mid-year is, I can't recall the year, but it was the capital gains rate. They made the effective date of the change, I believe it was the date the bill was announced or introduced. And it was like a September date. And so sales up to that date were taxed under the old capital gain regime, and sales post that date were taxed under the new capital gain regime. But that's the only time I can recall that an income tax provision was retroactive. That was not favorable to the taxpayer. I think we've had some retro law put in place that was favorable for the taxpayer.
One other question about Washington State. Is there a state tax over 2.2 million already in the state of Washington?
Yeah, that's correct. There's a federal estate tax. That's the 11 million we've been talking about. But Washington State has its own estate tax that kicks in at 2.2 million, and that rate starts at 10% and goes up to what, 24%, I think.
I think it's 19% is the top rate.
20. Oh, that's right. 20. Yeah. I was thinking it was, well, anyway.
It's up there. It's a lot of money.
It's up there. It's planning around that, and then you trade that against, well, gee, should I worry about that? What about capital gains? Well, if capital gains rates go up, that affects the calculus as well about how much we want to worry about Washington State estate tax.
What's interesting with the Washington State death tax regime is Washington State does not have a gift tax regime like the federal. The gift and estate tax regime on the federal basis are intertwined. They're basically one and the same. Think of the gift tax as a down payment against the estate tax. In Washington State, there is no gift tax, so there's this ongoing loophole, and I haven't seen any proposals to eliminate this, but because the 2.2 million threshold is substantially less than 11.5 and creates a planning issue, is in Washington State, you can have a deathbed gift. So say the second to die, say mom's on her deathbed and she's got 10 million bucks, and it would escape the federal death tax, but not completely for Washington State death taxes. Well, she could give away 8 million bucks roughly on her deathbed and sidestep the Washington State death taxes. I don't know, Ken, have you seen any proposals to change that in Olympia? No,
I've not seen anything.
I mean, it's such a glaring loophole, and all the planners, talk about it. I'm just surprised that Olympia hasn't figured out how to connect the dots and maybe close that loophole if they want to raise money.
Yeah, I'm not going to raise it to their attention, but.
So there's a question came in about limited partnerships as the entity of choice, and I think most of our panelists think that limited partnerships will probably continue as way to own real estate. So anyway, we are out of time. Gosh, it was a great session. We'd really like to thank our panelists, Benton Bray, Lyell Fracas, Tyler Opp, and Ken Williams. You guys are great CPAs, and we really appreciate your time. And if any of you guys are looking for a CPA out there, there's 4 good ones here you can call for real estate work. So thank you very much, everybody. Our event can be found on our website, which is CCIM-WA.com, and you'll be there shortly, and you'll be able to send it to your friends or watch it yourself.
Thank you, Fred, and thank you everyone for joining us. We look forward to seeing you on February's webinar.
So thank you very much. Thank you to the panel. Thank you to everybody that joined us. It was a great session about taxes.